Today we'll be talking about how to reduce your taxable income. 1. Through maximizing your 401k contributions. 2. HSAs. 3. FSAs. 4. 1031 exchanges. 5. Tax gain harvesting. And 6. Tax loss harvesting. So stick with us. Here are some common strategies to help reduce your taxable income. Keep in mind that individual circumstances may vary and laws change frequently. So it's a good idea to consult with your tax professional to get personal advice. In 2025, the maximum contribution limit for 401k is $23,500, and the combined employer and employer contribution limit is $70,000. Individuals that are over 50 can contribute an additional $7,500 per year. Individuals who are above 63 can contribute an additional $11,250. When you contribute to your traditional 401k, you are deferring your taxes. So that means you are postponing your taxes off until another date. So hopefully you would try to postpone those taxes onto a time at which you are making less income. With a traditional 401k, your taxes are deferred, meaning that you won't pay taxes on that money right now. You will be paying taxes later. So if you are making a high income now, it's best for you to try to defer some of that and to wait until you are making less income in later years. In those later years, when you have a whole bunch of money on your traditional 401k, it's best to start to do Roth conversions at that point. Roth conversions will then be taxed at that tax bracket which you are in that year. So let's say you are retired and you are making zero W-2 income. While you're making zero W-2 income, you can then do the Roth conversions. So with those Roth conversions and you are at a lower tax bracket, you pay much less percentage-wise. So let's look at this form right here. So if you're married filing jointly and you transfer $19,050, you will pay 10%. If you transfer up to $77,400, you will pay 12% on the amount above the $19,050. So, and then when you start reaching into the 22% bracket, that's when you may want to take your Roth conversions and spread them out throughout the years to try to stay in those 12% tax brackets. 2. An HSA. HSA is a health savings account. It is a high deductible savings plan for your health insurance. You need to have a high deductible plan through your employer to take advantage of this. The funds put into this account are tax-free for qualified medical expenses. For single filers, the maximum contribution limit is $4,300, and for family coverage, it is $8,550. There is a catch-up contribution for people over 55. They can contribute an additional $1,000. The great thing about an HSA, it allows you to take this money that you have put into this savings account, invest the money into the market. So, word of advice, whenever you put money into this fund, it then sets in like a bank account earning zero interest. So you actually have to take and move that into an investment fund to actually start investing. Otherwise, it will make zero money on itself. So zero will make zero interest and will not, work in the market. So if you put it in the market, it could, decline or go higher. It depends on which funds you put it into. The awesome thing about an HSA is you can use it for vision, dental, and qualified medical expenses. Qualified medical expenses include dental cleanings, exams, x-rays, filling braces, vision, you get eye exams, contact lenses, eyeglasses, laser eye surgery, and more. Mental health consultations, assessments, and treatments for mental health conditions, substance abuse, medical and therapeutic treatments for drug and alcohol addictions, service animals, guide dogs, seizure alert dogs, psychiatric aid animals, and acupuncture, chiropractic care, physical exams, blood sugar tests, and hearing tests also. So everything is included and allowed to be deducted from your HSA contributions. 3. FSAs. FSA is a flexible spending account. Maximum contributions to FSA are $3,300 annually. One important downfall of an FSA, and why I'm not so fond of these, is it is a use it or lose it account. So you put in money into this account and you may lose it within a certain time period. So I don't necessarily recommend this. I would recommend the HSA over the FSA. 4. A 1031 exchange. What 1031 exchange is an exchange of a like-kind exchange for real estate property. In Section 1031 of the U.S. Internal Revenue Code, it allows real estate investors to defer capital gains taxes when selling an investment property, as long as they reinvest the proceeds into a similar, like-kind property. The benefits of the 1031 exchange: they can defer capital gains taxes. You don't have to pay taxes on the profits from the sale if you have to reinvest in qualified property. Increases investment growth. Since you're not losing money in taxes, you can reinvest the full proceeds into a new property. And allows portfolio diversification. You can swap properties for other in different locations or with different cash flow potentials. 1031 exchange rules and requirements. You must, 1, invest it into a like-kind property. The property you sell and the one you buy must be investments or business properties, not personal residences. 2, equal or greater value. The new property must be of equal or greater value of the old one to fully defer taxes. 3, strict deadlines and timelines. 45-day identification period. You must have 45 days from the sale to identify potential replacement properties. 180-day exchange period. The new property must be purchased within 180 days of selling the old one. 4, use a qualified intermediary, QI. A neutral third party must hold the sale proceeds and facilitate the transaction. 5, same taxpayer. The entity or person selling must be the same as the one buying the replacement property. Example of a 1031 exchange. Suppose you own a rental property worth $500,000 with a $200,000 capital gain. Instead of selling and paying capital gains taxes, you would be 15 to 20%, or you do a 1031 exchange and reinvest the full $500,000 into another real estate property. This way, you defer the taxes and continue growing your investment. A 1031 exchange doesn't eliminate taxes forever. If you keep rolling over properties, you can defer taxes indefinitely or pass them to your heirs with a step-up basis, potentially eliminating capital gains taxes altogether. 5. Tax gain harvesting. Tax gain harvesting is a strategy to pay lower taxes on your investment gains. It is a strategy where investors intentionally sell investments at a gain to take advantage of low capital gains tax rates. This is useful if you're in a low tax bracket or expect to be in a higher tax bracket in the future. How it works: you sell investments at a gain, like you sell a stock or ETF mutual fund that has appreciated in value. Pay little or no taxes. If you're in the 0% capital gains tax bracket, you can realize gains completely tax-free up to a certain income limit. Reinvest the money. You can buy back the same investment or diversify into other assets. Who benefits the most? Low-income investors. If you fall into the 0% long-term capital gains tax bracket, based on your taxable income, you can sell and pay 0 taxes. Retirees in low tax years, this is perfect for you. If you're temporary in a lower tax bracket, you can harvest gains at the lower rate. People expecting higher future taxes, if you think your income will rise, you can lock in your gains today at lower income rates instead of paying higher taxes later. 2024 long-term capital gains tax brackets for single filers, 0% tax rate if income is up to $47,025. For married filing jointly, 0% tax bracket if your taxable income is up to $94,050. Tax gain harvesting only works in a taxable account, like a brokerage account. You can't do it in a tax-deferred IRA, and you cannot do it in a 401k, as you wouldn't realize the gains in such accounts. If your taxable gains exceed your losses, you could impact tax calculations that look at your modified adjusted gross income, or MAGI. This includes whether your Social Security benefits are taxed. So, couple things to be careful with. Examples of tax gain harvesting. Let's say you bought a stock for $10,000 and now it's worth $15,000. You are in the 0% capital gains tax bracket. Income under $47,025 for a single filer. You can sell the stock and realize $5,000 capital gains and pay $0 in taxes. You reinvest in the same stock or a different asset. If you wait and sell at a higher tax bracket, you could pay 15% or 20% in capital gains taxes instead of 0% today. Number 6, tax loss harvesting. Tax loss harvesting is when you sell investments at a loss, and those losses to offset gains in other investments. You then take the money from the sale and use it to buy an investment that fills a similar role in your portfolio, so you stay invested in the market. So this last point is critical. It's what distinguishes this powerful tax strategy from trying to time the market or locking in losses and provide the potential for increasing after-tax returns. When you tax loss harvest, you pay taxes on your realized capital gains for the year, meaning you'll only consider your net gains, the amount you gained minus any investment losses you realized. So if you know you're going to have some realized gains, you may want to see whether you have any opportunities to realize losses to offset them. For example, if you need to rebalance your accounts, you could sell shares of funds or stocks that have lost value since you purchased them. If your losses are greater than your gains, a year when you realized losses outweigh your gains is never fun, but by using tax loss harvesting, you can recoup some of those losses when you file. You can use up to $3,000 in net losses to offset your ordinary income, including income from dividends and interest. Note that you can also carry forward those losses to future years. Tax loss harvesting example. Let's put some numbers behind the tax loss and harvesting to bring it to life and demonstrate how it can help you save. Say, you sell investment A at a loss for $30,000, but you end up with $25,000 in realized gains from investment B. Your losses would offset your entire gain, which means that you won't pay capital gains taxes, and you'll have $5,000 in losses left over. Under current tax rules, you can use up to $3,000 of that loss to offset your ordinary income, and you'll be able to use the remaining $2,000 to offset gains or income in future years. Your estimated total tax savings in the current period from using tax loss harvesting would be $4,800, based on long-term capital gains rate tax of 15% applied for holding the fund for 1 year or more, and an ordinary income tax of 35%. Thanks for watching. I hope this video was useful, and I hope you can start saving some money on your taxes.